Something important is happening in the US Treasury market. And if you're only watching the stock market, you might completely miss it because the real story isn't necessarily happening on the Dow Jones. It isn't necessarily happening in the S&P 500, and it isn't necessarily happening in the latest technology stock. The story is happening in the bond market. The US government is borrowing enormous amounts of money. Investors are being asked to absorb that debt, and every Treasury auction gives the market a chance to answer one very simple question. How much does the world really want to lend to the United States at today's price? That question has become increasingly important. Because Treasury yields remain elevated, inflation risks haven't disappeared. Oil prices are creating another layer of uncertainty. The Federal Reserve's future path remains uncertain, and Washington continues to face enormous financing needs. This week is particularly important. The Treasury is scheduled to sell $58 billion of 3-year notes, followed by $42 billion of 10-year notes and $25 billion of 30-year bonds. That's $125 billion of coupon-bearing Treasury securities across 3 major auctions in just 3 days. And markets are watching closely, because when the government needs to borrow this much money, investor demand matters a lot. Now, let's be precise about something. A Treasury auction doesn't usually fail in the way a company can fail to sell a product. The Treasury can generally sell the securities. The real question is, at what yield? And to whom? And how much demand comes from investors versus dealers? Those details tell the real story. A so-called weak auction can still be fully subscribed, but it can force the Treasury to offer investors a higher yield than expected, and that can send a signal through the entire financial system. That is why Wall Street watches Treasury auctions so closely. Because Treasury yields aren't just numbers on a Bloomberg screen. They influence mortgages. They influence corporate borrowing. They influence government interest costs. They influence stock valuations. They influence the dollar. And they influence the cost of capital throughout the economy. So when a Treasury auction shows signs of weaker demand, investors pay attention. And this week, there are several reasons to be watching. First is the sheer amount of government borrowing. The Treasury is running a massive debt operation. The government needs to refinance existing debt while also financing new deficits. That means investors have to absorb a continuous stream of Treasury securities. And the bigger the supply, the more important demand becomes. Think about it like this. If one seller is offering 10 products and 100 buyers want them, the seller has enormous pricing power. But if the seller suddenly offers 1,000 products and there are only slightly more buyers, the seller may need to offer a better deal. Treasury auctions work through the same basic economic principle. The Treasury wants to borrow at the lowest possible interest rate. Investors want to receive the highest possible yield for the risk they're taking, and the auction establishes the price. That price is extremely important, because if investors demand higher yields, the government's borrowing costs rise, and that creates a feedback loop. Higher borrowing costs mean larger interest expenses. Larger interest expenses mean greater financing needs. Greater financing needs mean more debt issuance. More issuance can put additional pressure on the market, and that can create even higher borrowing costs. This is why bond market stress matters. It isn't just a Wall Street story. It can eventually become a Washington story. And then it can become a household story. Imagine a homeowner. They aren't buying a Treasury bond. They don't care about the auction. But mortgage rates are influenced by longer-term Treasury yields. So if Treasury yields rise substantially, mortgage borrowing can become more expensive. Now imagine a small business. It wants to borrow money to expand. Corporate borrowing costs are influenced by Treasury yields as well. If the government's borrowing costs rise, businesses may face higher financing costs. Then imagine a corporation deciding whether to build a new factory. If financing becomes more expensive, the company may delay the project. And suddenly, something that looked like a technical bond market event begins affecting investment and economic growth. That's why these auctions matter. But there is another important factor: foreign investors. For decades, U.S. Treasuries have benefited from enormous global demand. Central banks, pension funds, insurance companies, banks, investment funds, foreign governments, and individual investors all participate in the Treasury market. The United States has historically enjoyed a major advantage. Its government bonds are considered among the world's safest and most liquid assets. That gives Washington a huge financing advantage. But investors don't buy treasuries simply because they love America. They buy them because the combination of safety, liquidity, and yield makes sense. If the yield isn't attractive enough relative to inflation or other investments, demand can change. And if investors become more concerned about fiscal policy, currency risk, or geopolitical uncertainty, they may demand additional compensation. That compensation comes in the form of higher yields. This is the part Wall Street is watching. The question isn't, will anyone buy US debt? There will almost certainly be buyers. The more important question is, how much will investors demand to buy it? That is the signal hidden inside every auction. And one of the key numbers investors watch is the bid to cover ratio. Bid to cover tells us how much demand was submitted compared with the amount Treasury actually accepted. A higher ratio generally indicates stronger demand. A lower ratio can indicate weaker demand. But you can't analyze that number in isolation. You also have to examine the auction's high yield compared with the expected market yield immediately before the auction. That's where the concept of a tail becomes important. If the auction yield comes in higher than the market was expecting, traders may describe it as a tail. A tail can indicate that buyers required a higher yield to take down the debt. That can be interpreted as a sign of weaker demand. And that's why a treasury auction can technically be successful while still being described as ugly. The government sold the bonds, but it had to pay more to do it. And in a world where the US government is borrowing trillions of dollars, even a small increase in financing costs can become significant over time. This is where the current environment becomes particularly interesting. Oil prices are volatile. Geopolitical tensions remain elevated. Inflation is still an important concern, and investors are trying to determine where interest rates are heading. If investors believe inflation could remain high, they may demand higher yields on longer-term bonds. Why? Because they don't want to lock their money into a low return while prices rise faster than expected. If investors believe the Federal Reserve will keep interest rates high for longer, short and medium-term yields can also remain elevated. And if investors become concerned about government borrowing, the Treasury may need to offer even more attractive yields. These forces can reinforce one another. Now consider what happens if an auction disappoints. Bond prices fall. Yields rise. Traders adjust positions. Mortgage rates can move. Corporate borrowing costs can increase. The dollar can react. And stock valuations can come under pressure. Why stocks? Because the Treasury market provides a benchmark for the risk-free rate. When Treasury yields rise, the expected return investors demand from other assets can rise as well. That can put pressure on stock valuations, especially companies whose expected profits are far in the future. This is one reason technology stocks can be sensitive to bond yields. A high-growth company might be expected to generate enormous profits years from now. If the discount rate rises, the present value of those future profits falls. So a treasury auction can affect the stock market, even though the auction itself has nothing to do with stocks. That's the financial transmission mechanism. Bond market, interest rates, discount rates, asset valuations, and eventually the real economy. But there is another issue that makes this week's auctions especially important. The Treasury isn't selling just one security. It is selling across multiple maturities: 3 years, 10 years, 30 years. That gives investors information about demand across the yield curve. Shorter-term securities are heavily influenced by expectations for Federal Reserve policy. Longer-term securities reflect expectations for inflation, economic growth, fiscal policy, and the supply of government debt. If the 3-year auction is weak, traders may focus on monetary policy. If the 10-year auction is weak, the focus can shift toward inflation and fiscal concerns. If the 30-year auction is weak, investors may start asking much bigger questions about long-term borrowing costs. And that's why the 10-year and 30-year auctions can receive so much attention. The 10-year Treasury is one of the most important benchmarks in global finance. Mortgage rates reference it. Corporate borrowing references it. International markets watch it. And investors use it to price enormous amounts of financial assets. So if demand for 10-year debt suddenly weakens, the impact can travel far beyond Washington. Now, does a weak auction mean America is going bankrupt? No, absolutely not. That's an important distinction. The United States has enormous economic capacity. It issues debt in its own currency. The Treasury market is massive, and demand for U.S. government securities remains substantial. A single week auction does not mean the Treasury market is collapsing. It does not mean the dollar is finished, and it does not mean the United States is about to default. Those claims would go far beyond the evidence. What a weak auction can mean is something much more subtle. Investors may be demanding a better price. And if that happens repeatedly, it becomes important. One weak auction is noise. A pattern of weak auctions can become a signal. That's what investors should watch. Not one headline, not one number, but the trend. Are bid to cover ratios falling? Are indirect bidders becoming less active? Are dealers taking a larger share? Are auctions consistently tailing? Are treasury yields rising after auctions? Are foreign investors reducing their participation? And are longer term yields staying elevated even when the Federal Reserve is expected to cut rates? Those questions tell us much more than the phrase auction failed. And there is another group watching closely: primary dealers. These financial institutions have relationships with the Treasury market and play an important role in auctions. If demand from other investors is weaker, dealers may have to absorb more securities. That isn't automatically a crisis, but it matters because dealers don't want to hold enormous quantities of bonds indefinitely. They want to distribute them to other investors. If distribution becomes difficult, the market can become less comfortable with the amount of supply being issued. That is one reason Treasury auctions are such useful windows into market sentiment. They reveal who wants the debt and at what price. Now think about the broader fiscal picture. The United States has accumulated enormous federal debt. Interest payments have become a major part of the government's budget. Every time old debt matures, it has to be refinanced. If refinancing occurs at higher interest rates, the government's interest burden can increase. This doesn't happen all at once. Treasury debt has different maturities. Some bonds were issued years ago at lower rates, others mature sooner. So the government's average interest cost adjusts gradually, but the direction matters. If market yields remain elevated for years, the government will gradually refinance more debt at higher rates. That can make interest expenses grow. And that is why the bond market has become such an important part of the fiscal debate. Washington can debate spending. Washington can debate taxes. Washington can debate deficits. But ultimately, someone has to finance the difference. And that someone is the bond market. The Treasury asks investors for money. Investors decide what return they require. And the auction reveals the answer. This is the quiet power of the bond market. It doesn't hold press conferences. It doesn't tweet. It doesn't give speeches. It simply demands a price. And if investors become less comfortable with the government's borrowing trajectory, the price can change. Higher yields are the market's way of saying, we need more compensation. That doesn't necessarily mean investors are abandoning the United States. It can simply mean they're asking for a better deal. And that's a very important distinction. Now let's bring this back to Wall Street. Why would Wall Street not see this coming? Because markets are constantly trying to anticipate these events. Banks publish auction previews. Bond traders position ahead of auctions. Hedge funds monitor yield curves. Primary dealers manage inventories. And investors compare auction results with expectations. If an auction performs dramatically worse than expected, traders may have to reposition quickly. That can create sudden moves in yields. And because the Treasury market is enormous, even relatively small changes can affect other assets, but again, we should not exaggerate. There is no evidence that one auction by itself represents the collapse of Treasury demand. The official Treasury data shows that recent auctions have attracted substantial bids. For example, a June 91-day bill auction received roughly $248.8 billion in total tenders, against about $89 billion accepted, producing a bid-to-cover ratio of 2.79. A June 28-day bill auction had roughly $209.6 billion in total tenders against about $70 billion accepted, for a ratio close to 2.99. Those numbers demonstrate something important. There is still enormous demand for U.S. government debt. So the story should not be, nobody wants treasuries. That's simply not supported by the evidence. The more credible story is, the market is becoming increasingly sensitive to the price Washington must pay to borrow. And that is a much more interesting story, because if investors continue demanding higher yields, the consequences can accumulate. Higher treasury yields, higher mortgage rates, higher corporate financing costs, higher government interest expenses, potential pressure on equities, and potentially a stronger dollar if higher yields attract global capital, or a weaker dollar if investors interpret rising yields as a sign of deteriorating confidence. The direction isn't automatic. Markets are complicated, but the sensitivity is real, and that's why this week's auctions matter. The 3-year auction tells us something about near-term demand. The 10-year auction tells us something about longer-term confidence. And the 30-year auction could tell us how investors feel about America's long-term fiscal and inflation outlook. If all three are strong, the market can breathe a sigh of relief. If all three are weak, investors may start asking more serious questions. And if one is weak while the others are strong, traders will try to determine whether the problem is temporary or structural. This is how Wall Street thinks. It doesn't necessarily react to the headline. It reacts to the deviation from expectations. That's why the auction results matter. Not simply because the government sold debt, but because the market reveals what price it demanded. Now imagine a more extreme scenario. Suppose Treasury auctions repeatedly require higher yields. At first, investors may simply accept the change. Then mortgage rates rise. Corporate borrowing becomes more expensive. Companies slow investment. The government pays more interest. The deficit becomes harder to manage. And investors demand even more yield. That would be a dangerous feedback loop. We're not saying that is happening now, but it is the scenario investors are watching, because the sustainability of government debt isn't determined by the debt number alone. It's also determined by the interest rate. A country can carry a large debt burden if financing costs remain manageable, but if interest costs rise significantly, the budget pressure becomes more difficult. That's why bond traders pay so much attention to inflation. If inflation falls, long-term yields can decline. If inflation rises, yields can climb. And right now, energy prices and geopolitical risks are making that picture more complicated. Oil can influence inflation. Inflation influences interest rates. Interest rates influence treasury yields. Treasury yields influence borrowing costs. And borrowing costs influence economic activity. That's the chain. And it starts with something as simple as a barrel of oil moving higher. This is why the Treasury market can be so fascinating. It connects almost everything: government spending, inflation, Federal Reserve policy, oil, geopolitics, housing, corporate investment, stock valuations, and the dollar. One auction doesn't determine the future, but auctions help us see how investors are processing all of those risks. And that is why the market is watching this week's sales. So what should investors watch next? First, the bid to cover ratio. Second, the auction yield versus the pre-auction market yield. Third, the percentage of securities allocated to indirect bidders. Fourth, how much primary dealers are forced to absorb. And fifth, what Treasury yields do immediately after the auction. That final point is crucial. Sometimes an auction looks weak on paper, but the market shrugs it off. Other times, a mediocre auction triggers a major move because traders were positioned for something much stronger. Market reaction provides context. And then comes the 10-year auction. That may be the bigger event, because the 10-year Treasury is one of the world's most important financial benchmarks. If demand is strong, investors may conclude that the market can absorb the government's issuance at current yields. If demand disappoints, yields could move higher. And if yields rise sharply, that can affect mortgages, stocks, and corporate bonds. Then the 30-year auction arrives. That is where the long-term story becomes even more important. 30-year investors aren't simply betting on what the Federal Reserve will do next month. They're thinking about the next 3 decades: inflation, government debt, economic growth, fiscal policy, population, productivity, and the credibility of American institutions. That makes long-duration Treasury demand an important indicator of long-term investor confidence. So no, one auction isn't the end of the world. But the bond market is giving us information, and smart investors pay attention to information before it becomes a crisis. That's the real lesson. Don't watch for the dramatic headline. Watch the numbers underneath it. Don't ask whether the Treasury failed. Ask what yield it had to offer. Don't ask whether foreign investors disappeared. Ask how their participation changed. Don't ask whether Wall Street panicked. Ask whether yields moved after the auction. Those questions lead to better analysis. And there is one final point. The United States still possesses enormous advantages. The dollar remains central to global finance. Treasuries remain highly liquid. The American economy remains enormous. And there is no simple replacement for the depth of US financial markets. That means investors aren't suddenly walking away from America because one auction is weak. But that doesn't mean Washington has unlimited borrowing power at any price. There is always a price. The market determines it. And every Treasury auction is another vote on that price. That's why this week matters. Not because America suddenly lost access to credit, not because the Treasury market collapsed, and not because Wall Street suddenly abandoned US debt. The real issue is whether the cost of financing America's enormous fiscal needs is becoming more sensitive to investor demand. If it is, that will matter. It will matter to Washington. It will matter to the Federal Reserve. It will matter to Wall Street. And eventually it can matter to ordinary Americans, because the bond market is where the government's promises meet the market's price. And this week's auctions are giving investors another opportunity to measure that relationship. So watch the 3-year, watch the 10-year, watch the 30-year, watch the bid to cover, watch the tail, watch dealer demand, and most importantly, watch the trend. Because one week auction can be ignored. Two can raise eyebrows. A long sequence of disappointing auctions can become a genuine warning. And that is the story investors should be following. The Treasury market doesn't need to collapse for a problem to matter. Sometimes the warning begins much earlier. A few extra basis points, a slightly weaker bid to cover, a little more inventory on dealer balance sheets, a little more compensation demanded by investors. Each number looks small, but together they can tell a much bigger story. And that story is about the price America has to pay to finance itself. For now, the US Treasury market remains enormous and functional. But the pressure points are worth watching. Because when the world's largest borrower goes to market week after week, demand isn't just a technical detail. It is the market's verdict. And this week's auctions are the latest test. The question isn't whether America can borrow. It can. The question is, at what price? And if that price keeps rising, who ultimately pays for it? That is the question Wall Street is asking, and it is a question Washington cannot afford to ignore.